I read the email that there was gonna be a commission-free brokerage in Singapore, I was like, what? That's insane! So welcome back to another video. My name is Gerald, and today I'm going to be talking about Singapore's cheapest brokerage for both the US side as well as Singapore side. I'm going to just flat out tell you what these companies, like what the brokerage firms are, and I'm also going to talk about what does this all mean and why is it so significant. And I'm also going to cover, like, are there really no cost to this? Do they just reduce price and that's it? Or are there like hidden costs that we need to be aware of? Additionally, I will share with you what I think on whether this is safe or is it unsafe because it's a lot cheaper. And last but not least, what this means for the future. Alright, so let's begin. So I'm just going to flat out tell you guys what the name of the brokers are, right? So if you want to invest in the US market, right? So because US is the biggest stock market in the world, the name of the broker in Singapore, or brokerage house in Singapore, it's called TD Ameritrade. So basically, they announced in their email newsletter that they're going to provide $0 fees. Basically, you want to buy stocks, you want to buy options, you want to buy your ETFs, free. Not free, but you need to still pay for the stock, but you get the idea. No fees. And if you want to buy stocks that are in Singapore, unfortunately, TD Ameritrade does not allow you to buy Singapore stocks, but there is an alternative broker which is called Tiger Brokers. And basically, I started investing when I was 18 years old. And back then, I think Standard Chartered had the best deal in Singapore. That was before, was it before? Yeah, that was when interactive brokers require you to have like a big, initial capital in order for you to invest there. So I was 18 years old. I didn't have much money back then, like $3,000. So I was trying to learn like value investing. And when you learn about investing, you very quickly learn that there's two important things that you should try to adopt. The first, dollar cost average, because that brings your cost of purchase down so you don't buy like one lump sum. And secondly, you want to diversify. So the more intimately and the more you know the stock, the more you can concentrate your portfolio. And if you're new, like I was, you needed to diversify a little bit more. So Benjamin Graham, an intelligent investor, recommended like about 30 different stocks. So that was what I was trying to aim for. But the problem was with a $3,000 portfolio, if I were to buy individual stocks, I would pay like 4-5% in commission rates just to buy individual stocks if I were to buy them at like $500. And even so, I wouldn't be able to buy like 30 stocks. Make sense? So if I were to buy like individual stocks, let's not talk about the fees. It's just insanely high. So one way around it back then, when I tried to try to dig my way around to find loopholes in the system or in Singapore's brokerage scene, was that I would buy through regular savings plan. So if you don't know what regular savings plan is, basically you can work with your local banks. They have a brokerage or trading firm. Basically, you can invest in stocks or ETFs, and you just pay a monthly amount. Like every month, you pay like $500, $100 to up to as much as you want, and the banks will help you buy those stocks and keep those shares on your behalf. So it's kind of like a regular savings plan, but instead of saving money, you're trying to save stock or buy more stocks every single month. So the commission fee is like 1% back then, and I realized for OCBC, you could buy individual the blue chip stock. So you could buy all the banks which I wanted to buy, and that's when you could buy them for like $100 every month. And that was one way I kind of skirted around the high trading fees, right? So problem with that was that the benefit is you get to diversify, you get to buy different ticker symbols, and you also get a dollar cost average. Problem was it was not liquid at all. So lo and behold, recently we have brokerage firms that are competing to reduce the price, and now finally $0 or no minimum commission fees in Singapore. That's insane. What this means is that now it is much easier for you to diversify and buy individual stocks, so you don't have to fix yourself to buy ETFs, not anymore. In fact, recently it has become so cheap that it would be even better for you to just outrightly use the Tiger Brokerage app to buy the Singapore index on your own than to use the regular savings plan. So let me give you a simple example. If you were to buy through like Maybank, they charge like 1%, so that's $1 a month. If you were to use the Tiger Brokers app and buy it from the market, you pay 8 cents. That is how insane it is. What this means is that it's a lot easier for you to buy different asset classes so that your portfolio remains stable, especially during times of economic uncertainty like right now. And when one competitor has the best deal in town, what happens is that other people will start to compete. Like recently, Poems started to have a no minimum brokerage, and they matched Tiger Brokerage commission fees of 0.08%. So that itself would create even more competition, which would encourage everyone to essentially try to compete on the lowest price. This also encourages a lot of new investors to begin actively managing their portfolio. So this means liquidity in the Singapore market is going to go up, commission fees is going to go down. In fact, I paid like I think $1,500 a year in trading fees or fees to the brokers on a year. So this year I paid about $1,500, last year I paid about $1,500. Total that's like $3,000. Can you imagine what would you do with an additional $3,000? And that's because I not only buy stocks, but I also buy options, and options are expensive. So yeah, that's a lot of money, $3,000, friends. But now the real question is, does all these savings come at a cost? What are these brokerage firms doing differently that they can pass on this seemingly insane savings to us, right? So when I try to do a little bit of research and understand the US traders, because US had $0 commission, $0 trading for a significantly longer time compared to Singapore. So we could basically, if you want to learn, we could learn from them. What are the problems that they face? And here's what I found. The first thing that's going to go is customer service. So if you are a trader, you're not an investor, you trade, you would want to be able to get live support and help very quickly. But the problem is that when brokerage firms provide, essentially $0 trading fees, what a lot of the firms eat up is customer service. And when you check out Tiger Broker's customer service, here's what you see. Basically, you're wondering, where is the live support? So yeah, that's what I got. Be sure to rate the chat, give him a thumbs up, and press send. That is probably one area in which they probably reduce the cost. And the second area in which I've read is when they try to, route your trades. Like when you enter a trade, right? If you pay an expensive brokerage firm, basically they use faster servers, better connectivity, or something like that. Basically you get a better spread or better ask. But in the case of a low-cost brokerage firm, that's what they cut. So you may not get basically the best price or best bang for your buck. But again, this affects traders. So if you are like an investor, you invest for the long term, 2 cents may not matter that much for you unless you're buying like penny stocks. So basically, looking at the facts, it seems that low-cost brokerage has a place in the market. Investors would benefit greatly and have or experience a lot of savings. But then the question is our money actually safe? Like imagine putting $50,000 or $10,000, which eventually grew to like $50,000, and then boom, company goes bankrupt, you lose all your money, right? So that's when I think the MAS steps in, and that's when the FDIC insurance or SDIC, basically the insurance steps in to protect individual investors from loss of capital. I think most of the time they protect up to like $50,000, but in the case of Tiger Brokers, you get none of that. TD Ameritrade though, you get protected up to $50,000, so that's a relief. On the bright side, we know that Tiger Brokers is regulated by MAS, so it is safer or safe, but not safer than TD Ameritrade, like an established bank. On the other hand, we also know that Tiger Brokers do not directly manage our money. Like if you invest in the Singapore market through Tiger Brokers, what they do is that they use a custodian DBS Bank. So even if they go bankrupt, your money is still safe with the DBS Bank. And if you invest in overseas market through Tiger Brokers. Basically, they use Interactive Brokers, which is one of their investors, as a custodian. So in other words, your money is in the safe hands of a much bigger and much more established brokerage firm in Singapore. So that should answer a lot of your queries, like especially those of you who heard, wow, Tiger Brokers from China are safe or not, right? So hopefully that answers your question, but more importantly, what is the future going to become? Because this is important, right? So if we look at the US trading, if we look at the US brokerage houses as a role model or as an example of where we are headed towards, we've achieved basically no minimum brokerage or commission fees. Where do you think is going to happen next? I believe it's going to be fractional shares. That's correct. So currently, we don't have fractional shares, but in Singapore, in the US, if you use apps like Robinhood, you get to buy like fractional shares. So imagine buying 0.2 share of like Tesla, which is like $1,000 share. That's before the stock split. But if you can buy fractional shares, that means that you have even more ability to control and manage your portfolio. So I'm looking forward to that. I think that really helps improve liquidity and makes it a lot easier for new investors to enter the market. But at the same time, it also makes it a lot easier for people to foolishly manage and trade and lose money in the market. So what do you think of this? I think it's a great news for me because I get to save money. What do you think? And here's the last part. As you can see, this is $50. You know that there is a way in which you can get $100. 2 of this for free, or basically up to $100. Basically, Tiger Brokers is offering up to $100 in stock discount if you signed up with their account right now till end of this year. So open an account, fund it with an approximate amount of money. So basically, the more you fund it with, the more money they give you, and it can be as much as $100. So do check out the table. I have listed the details around here. So it's a good deal because they give you the money based on how much you funded with, and you can take out the money after, no problems there. And an additional tip for you, by the way, if you want to invest in the US stock market, try not to use the banks or the brokers conversion rate. What I would do is to use Revolut. So I will convert money from Revolut to the foreign currency like the US dollar and then transfer it to the bank. That's where you get the best exchange rate. So same goes for Interactive Brokers and other brokers. Basically, exchange using a good, proper exchange app. That's how I save money. I hope this is helpful, and if you would like, please check out other videos on investing over here or see what YouTube recommends you over here, and I'll see you next time. Take care, everyone. This is Gerald signing out.